I know the Central Bank of Nigeria conducted its Treasury bills auction for September there across the 91-day, 182-day, and 364-day tenors. Let's drill down on the results now with Caleb Alimi, the chief dealer at Providus Bank. Great to have you on the show, Caleb.
Thank you, Laddie. Good morning.
Fantastic. We had the auction results. We're seeing oversubscription. I believe especially for the 364-day bill. What does it say about investor sentiment and liquidity in the system?
Well, let's start with liquidity. Liquidity has been a lot in the system. I think over the past 1 or 2 weeks, the average liquidity has been around 2 trillion, 1.9 to 2 trillion among the banks and with deposits with CBN. So that has contributed largely to what we're seeing in the market. The market has been expecting a bit of open market operation from the central bank, but we haven't seen that. That hasn't come up yet. And obviously, we know the central bank probably has a plan up their sleeves, and then we're seeing that investors are looking for where to put their money. That's, informs the subscription at this, just concluded NTB auction. 1.4 trillion, in subscription for only the 1 year paper. Of course, the debt management office through CBN sold only about 250 billion of that. They didn't take up all of that. So we can see that 272 billion, I beg your pardon. So we can see that, there's a lot of appetite because, investors are looking for where to, deploy these funds to. But of course, there's still that, like your last guest said, there's the cautious optimism looking out for a proper direction from the CBN.
So why do you think the shorter term 91-day, 182-day tenors, why do you think they attracted less subscription?
We often see that. We often see very little subscription for those two tenors, largely because, people are after yield. The longer you hold fixed income securities for, the better your yield return is. So that's why we see a lot of interest in that 1 year paper.
So with stop rates, ranging between 15 and about 16.78%, what do these levels indicate about, government borrowing costs, in today's environment?
The government continues to borrow cheaper and cheaper, given what we know about the deficit in the budget. We should think they should be borrowing more at this point. But currently, this is what they have an appetite for cheaper borrowing. And we can see that. Look at what has happened. They've cut the 1 year borrowing rates, dropped almost 100 basis points, 91 basis points specifically from 17.69 to 16.78. We can see that these guys want to borrow, but they want to borrow cheaply and as cheaply as possible. We also expect that we'll see a similar trend in the bond auction that should happen next week.
All right, definitely. I love me some, cheap credit. But, for retail and institutional investors, what strategies, make sense right now, given the current NTB yields?
What we find is that this provides an opportunity for corporate borrowers. The federal government, which is risk-free, looks to borrow as cheaply as possible. But then corporate borrowers, blue chip companies that approach the market through commercial papers, companies that approach banks for loans can always reference this 1 year NTB to say, look, the rates are lower, so definitely borrowing costs across the economy should also generally be lower. And then we should see that credit sort of extend to real sector at lower costs. I think the benefit is for the real sector borrowers, really.
All right, so we had the Fed, the first cut, interest rate cut there in the U.S. Any impact for Nigeria's fixed income market? What should investors be looking at?
So what we think would happen, what we see would happen is there should be a bit of yield pickup for Nigerians. We should see foreign investors, looking for that aggressive yield, looking for better returns to come to Nigeria. So we could see more competition for yields in Nigeria. We could see, yield compression in this market space. Well, we're already seeing that play out in the Eurobond space. The yields in Eurobond space have continued to, trend lower based on this cut. The cut has already been priced, and market expected 25 basis point cuts, which is in line with market expectations. So we've seen yield compress on the Eurobond space. We think that is part of what we're seeing in the local fixed income market as well. And then we think more of it is going to happen.
And, looking ahead for the rest of the year, what trends are you expecting in the fixed income market? We're hearing that with rate cuts expected, from the MPC here in Nigeria, money is going to move over more to the equities market. Is that what you're seeing?
Oh, definitely. Definitely, that's what we expect. Look at where the one-year yield is. It's somewhere around the 19%. And the stock market has done over 60% this year already. I'm sure some particular papers, some particular securities have done 150%, 200%, and all of that. So we do think investors will move to the equity market, especially as we approach the end of the year, to enjoy that decent yield. I think that the equities market is poised for greater gains.
Right. We'll definitely keep our eyes on that. And are you expecting a cut by MPC next week?
I also shared the last. Guest
Engineer Falabi
position.
Yeah.
Yes, I share his position as well. I think the MPC, they could cut, but I would also think they should wait out for a bit to consolidate the exchange rate gains we're seeing. Once there's a cut, based on the cuts in the US, we expect more FPIs to come to Nigeria for that yield pickup and all of that. So I think they should hold on, and not cut just yet. Or if they could cut, maybe a very small cut.
Maybe 25 basis points or less than 25.
Yeah, something like that. Maybe no, 25 basis
25,
points is the least
yeah.
they should do. Yeah. So that small cut, should actually, that could, the market won't see it as anything big, but I mean, it could just signal that, okay, the easing cycle is commencing from their contractionary monetary policy stance.
And definitely, I want to believe the MPC would also consider inflation rates. That's been slowing at about 20.12%. That's the last one.
20.12, yeah.
20.12.
It's very encouraging.
Real interest rates, real returns at this point.
The inflation data is actually very encouraging, but I think they should wait for a bit to see it further consolidate. But I mean, the last three inflation readings have actually come down. So I think that could also serve for them to say, look, those also support their reason for a cut or market's expectation for a cut. But I think it would be good for them to just wait and let that consolidate for a bit, and then maybe cut at their next meeting, a bumper cut at their next meeting.
Bumper cut. Well, we'll see. We'll keep watching, at this point. Investors, I guess, just trying to get direction now when it comes to interest rates and inflation. Thank you so much, Caleb Alimi, Chief Dealer, Providus Bank. Thank you for coming on today. And have a profitable trade.
Yeah, thanks.
Fantastic. Cheers.